how to get started, building your first investment plan. All right, now that you understand what investing is, how money grows, and what kind of investment are out there, let's get to the question everyone asks. Okay, but how do I actually start? This is the part where the learning turns into action. Starting to invest can feel intimidating, but once you take the first few steps, it becomes natural. Let's break it down together, step by step, so you can start building your very first investment plan. Step 1. Define your why. Before you invest a single dollar, you need to know why you're investing. Your why is the engine that keeps you consistent when markets go up and down. Maybe you're investing to retire early. Maybe you want financial security for your family. Maybe you just want your money to stop losing value to inflation. Whatever your reason, write it down. Because investing isn't a one-time action. It's a long-term relationship with your money. Knowing your why keeps you focused when things get tough. Step 2. Set clear goals. Once you know your why, set specific goals. Ask yourself, what am I investing for? How much money do I want to grow? By when? For example, I want to build $100,000 for retirement in 25 years. I want to grow $10,000 into a home down payment in 5 years. Setting clear goals helps you choose the right type of investments. Short-term goals, 1 to 5 years, need safer investments like bonds or cash equivalents. Long-term goals, 10 plus years, can afford more risk and reward, like stocks or crypto. A goal without a timeline is just a wish, so make it specific and measurable. Step 3. Understand your risk tolerance. Everyone has a different comfort level with risk. Some people can handle seeing their portfolio drop 20% and stay calm. Others panic if it dips 5%. Neither is wrong. It's just personal. Your risk tolerance depends on your financial situation, how much you can afford to lose, your age and time horizon, your personality and experience. The more time you have, the more risk you can generally take. Because markets tend to recover over time, a younger investor might focus on stocks and crypto for growth. Someone closer to retirement might shift toward bonds and dividend stocks for stability. Knowing your risk tolerance helps you sleep at night and stay invested when things get bumpy. Step 4. Build your foundation. Before investing, make sure your foundation is solid. That means paying off high-interest debt like credit cards. You can't out-invest 20% interest. Building an emergency fund. 3 to 6 months of expenses in a savings account. Having stable income. Consistent cash flow to invest regularly. Once those are in place, you're ready to build. Think of it like constructing a house. Your savings and emergency fund are the foundation, and your investments are the structure on top. Step 5. Choose an investing platform. Now it's time to actually start. You'll need an investment account. That's where your money lives and grows. If you're in the U.S., that might mean a brokerage account with platforms like Fidelity, Vanguard, or Robinhood. If you're outside the U.S., there are plenty of similar apps like eToro, Interactive Brokers, or regional platforms. And if you're investing in crypto, You'll use a crypto exchange like Coinbase, Binance, or Kraken. Pick one that fits your goals, is easy to use, and has low fees. Make sure it's reputable, regulated, and offers the assets you want to invest in: stocks, ETFs, or crypto. Step 6. Start small, stay consistent. Now for the best part. You don't need a fortune to start investing. Thanks to modern platforms, you can start with as little as $10 or even $1. The key isn't how much you start with. It's how consistent you are. This is where a strategy called dollar cost averaging, DCA, comes in. It means investing a fixed amount regularly, like $50 or $100 every month, no matter what the market is doing. When prices are low, your money buys more shares. When prices are high, it buys fewer. Over time, it averages out, removing emotion from the process. Consistency beats timing, every single time. Even if markets dip, you're still building wealth because you're buying more when prices are cheaper. Remember, time in the market beats timing the market. Step 7. Build a simple portfolio. When you start, keep your portfolio simple. You don't need dozens of assets. You just need a few solid ones that fit your goals and risk tolerance. A basic example: 60% in a broad stock market ETF, like S&P 500, 30% in bonds or a bond ETF for stability, 10% in crypto or alternative assets for growth potential. That's a diversified, balanced portfolio you can grow and adjust over time. As you gain experience, you can explore more, like dividend stocks, REITs, or DeFi projects. But at the start, simplicity is your best friend. Step 8. Automate and forget. One of the best investing hacks is automation. Set up automatic transfers into your investment account every month. That way, investing happens without you even thinking about it. You remove the temptation to time the market or wait for the right moment. Automation turns investing from a stressful decision into an easy habit. Over time, those automatic deposits grow into serious wealth, all while you're busy living your life. Step 9. Keep learning and stay patient. Once you've started, the journey doesn't end. It just evolves. Markets will go up and down. You'll see headlines saying recession or crypto crash. Ignore the noise. Focus on your plan. Keep learning. Read books. Watch educational videos. Follow credible finance creators. The more you understand, the more confident and calm you become. And most importantly, stay patient. Wealth grows slowly, then suddenly. Small, consistent steps will take you farther than trying to get rich quick. As the saying goes, the best time to invest was 10 years ago. The second best time is today. That's the end of part 4. You now know how to actually start investing, from defining your goals to automating your wealth building system. In part 5, we'll cover the final step: how to protect your investments, manage risk, and build the mindset of a successful long-term investor. Thanks for watching. Like and subscribe for more.